Hello and welcome to the latest episode of Meet the Investor. Joining me today is Stephen Otter, Global Head of Private Market Royalties at Partners Group. Thank you for joining us today, Stephen.
Pleasure to be with you, Joey.
I'd love to start with a little bit about your background and history, right up to your current role at Partners Group, if you could.
Sure, happy to do so. So, as you can probably tell from the accent, from the UK, studied at the London School of Economics, then spent 10 years in investment banking. Then I spent 6, 7 years doing energy royalties on behalf of a US private equity house. Then in 2020, I started speaking to the three founders of Partners Group to join their family office to basically build them a cross-sector royalty strategy, which was seeded with their own capital. And then after having 2, 3 years of good success in the family office, we actually then moved the strategy over to Partners Group, launched it as the fifth asset class, which we did at the beginning of 2024.
So let's start right at the start of this asset class. What are royalties?
Yep. So when undertaking royalty investing, there's kind of three things you need to remember. The first is we're an asset owner. So we own things like IP, so copyrights, patents, license agreements. We also own subsurface rights. We also own land title. So we're not credit, we're not lending, we are the asset owner. The second thing, though, and this is what makes us different from private equity or infrastructure, we do not operate the assets that we own. We have a third party operate the assets, and they are responsible for funding all of the costs. So we don't fund any OPEX or CAPEX associated with the assets that we own. And then number three, and last but not least, when the asset that we own, which is operated by a third party, generates revenue, we receive a percentage of the revenue. So let me give you an example in the healthcare space. We own a royalty on a product called neffy. Neffy is a nasal inhaler which treats severe allergic reactions. We think it's going to replace the EpiPen as a kind of go-to treatment. We don't manufacture neffy, we don't distribute neffy, we don't fund any of the costs of neffy, but every time neffy is sold, we receive a percentage of the revenue line for the duration of the IP, which is typically 15 years. So we're giving our investors top-line revenue exposure to specific assets across different sectors.
And you sort of touched a little bit on the history there with respect to the Partners Group founders and working with them. How has Partners Group generally been involved in royalties historically? Has it really been amongst the purvey of the founders only?
Yeah, so it really started out as an initiative in the family office where they started looking into it in kind of 2018, 2019, made their first investments into the space. The reason being is that they were looking for uncorrelated diversifying strategies which can help stabilize their broader portfolios, which obviously include public equities, traditional private markets investments. And so they saw royalties as a area where there's low correlation to broader markets. It's driven by uncorrelated and attractive yield from underlying assets. And so we really scaled it in the family office. At the time, there was no expectation we would move it over to Partners Group. But as we dived deeper into the thesis around royalties, the founders really understood the size of the market and what it can do to investors' own portfolios, having witnessed what it had done to their own. And so at that point in time, they decided to move it over to PG. And I should say they don't launch new asset classes lightly at Partners Group. This is the first new asset class in nearly 2 decades. And so it really speaks to the conviction the founders have around royalties as a standalone asset class, and importantly, the role it can play in investors' broader portfolio.
And so going deeper into royalty strategies, you touched on a healthcare example before. What other areas of royalties does the strategy go into?
Yeah, so we see this as a $2 trillion market and growing, which often surprises people by the scale of it. It's much, much bigger than people think. When you first speak to investors, I think many people just assume it's only music royalties. It's much broader than that. So we focus today on kind of three big sectors. Number one, life sciences or royalties in the healthcare space. The second big sector we look at is energy transition. So that is US natural gas royalties, that is water royalties, that is carbon royalties, that is green metals, so royalties on green metals. And then the third big bucket we look at is entertainment, which again, people assume is just music. It's not, it's film and TV IP, it's music from film and TV, it's book royalties, it's theatre royalties, it's royalties in sports and in brands, and it also includes YouTube royalties. So we see this as an incredibly large opportunity set. To kind of contextualize that, we look to execute 20 to 30 new investments a year into our evergreens, and we are seeing between 10 to 20 new opportunities a week. So it's a very large opportunity set. And it's also growing because increasingly more and more sectors are looking to royalty financing as a financing tool for their own businesses. because if you take a royalty over an asset that you have, it isn't accounted for as debt. So it's a non-dilutive, non-credit form of financing. And so the actual royalty sphere is increasingly growing daily based on the innovation around the structures that you can use to invest into royalties.
So, just to bring some of that to light a little bit more, can you give us examples in the two non-healthcare sectors that you mentioned there, so entertainment and commodities, I guess?
Yeah, so in commodities, we own over 3,300 producing gas wells in the US. So every time those gas wells generate gas and the gas is sold, we get a percentage of the revenue from that gas being sold. And the US is very unique in that when you buy land, you can own the surface rights, but you can also own the subsurface rights. So we are the owners of subsurface rights across hundreds of thousands of acres in the US, where we have gas producers on our property producing gas. They're funding all of the costs associated with those wells, including if they decide to go off and drill new development wells. We're not involved in the OPEX or CAPEX of that. But as and when they produce any gas from our acreage, we receive between 1 to 10% of the gas revenue. So it's really giving our clients top line revenue exposure to gas wells in terms of volumes and pricing. In the entertainment space, to give an example, last year we were part of a consortium who bought into an SPV that owns all of the music that Warner Brothers has ever put into their entire film and TV catalogue. So we don't own the IP of Harry Potter, but we are an investor in the music in Harry Potter. So whenever you watch Harry Potter and you hear any of the songs being played in the background while you're watching the film, we are generating royalties from that. And so literally every title of Warner Brothers, we now own a percentage of the music across their entire film and TV catalogue. So again, top line revenue exposure to best in class IP across the various sectors that we're investing in.
So going back to something you alluded to earlier, why would someone be interested in selling off a future royalty stream?
Yeah, so it's various reasons. If you look at the healthcare space, we're typically buying the royalties from the original inventors. So universities, small R&D, they create the IP, they then enter into a license agreement with a big pharma company who then takes over in terms of the manufacturing, the distribution. They brand it as their own big pharma product and then they sell it. And in return for being allowed to use the IP, they will enter into a license agreement where they will agree a royalty to the original inventor, such that every time the product is sold, the original inventor benefits from the sales. Now, those royalties typically last for 15 years from FDA approval. The original inventor may not want to sit there and clip a percentage for 15 years. They may want to monetize today because they want to go off and invent their next product. I mean, they're there to drive R&D. And so in healthcare, a lot of the transactions are buying from the original inventor, which is important because you're bringing fresh capital into the healthcare industry to lead to more innovation and R&D. So that's the first reason. If you then look in the entertainment space, the original creators of music or film and TV IP, again, I think it's a choice. Do they want to sit there and take royalties over the next 70 to 80 years, or do they want to pull forward the cash flow and have a monetization event today? And then the other two areas we don't just buy a royalty, right? So what I alluded to was buying the healthcare royalty or buying the music royalty or the entertainment royalty. The second thing we do is we lend against royalties. So if you're a royalty owner and you don't necessarily want to sell because you truly believe in the upside of your product, then we will often come to them and provide a loan secured against the royalty where we are paid back from the royalty cash flows. But once we are repaid and we've hit a certain amount of return, then the IP stays with the original owner. And so actually 50% of the transactions we have done in the entertainment space over the last 12 to 18 months have been us lending to the artist and being secured against their pool of royalties. And that's attractive to an artist because they don't suffer huge capital gains tax because they're not selling, they're borrowing. They also importantly retain control of their music rights, so they're not going to wake up the next day and suddenly see their music in an advert which they wouldn't want to be associated with. And so that's also important. And then the third thing we do, we create royalties, which people always go misty-eyed when I say that. But actually all I mean by that is we can approach a company, and this can be in any sector, right? We're not doing it in any sector, but just to show you how broad the market can be. You can go to a company and say, we like asset A, B, and C in your portfolio. Here is $100 million. And in return, we will take X percentage of the revenue from those assets as and when they produce revenue. And that is increasingly becoming more and more attractive to counterparts, because as I mentioned earlier, if you create a royalty in the right way, it doesn't get accounted for as debt on the balance sheet, nor from a credit rating standpoint. And it's also not equity. We don't have governance. So it's a non-dilutive, non-credit form of financing. And that area is expected to grow just in healthcare by 5x over the next 5 years.
You mentioned with healthcare as an example, it could be a patent that lasts a certain number of years. I guess in entertainment as well, whilst it might not be as fixed, there could be a dilutive value to particular parts of the entertainment industry over time. Those things become less popular. How does that managed from the perspective of a valuation, or do these things trend towards almost zero value over the long term?
Yeah, so it's a good question. It's dependent on the sector. So if you think about healthcare, you have a clear line in the sand, which is when the IP expires, you should assume zero residual value. So over the life of the healthcare royalty, it's depleting to zero. But obviously, you're taking the cash back, and in the funds, we're reinvesting it or paying out as a distribution. Same on the energy side, you're getting a percentage of revenue for the life of the mine or the life of the well. So if there are no new wells or no new mines coming on stream, then yes, through time, it's depleting to zero. Albeit there may be points in time where it goes up, because if the gas price goes up or the gold price goes up, then obviously the NAV of the overall project goes up. But again, it's depleting to zero. Entertainment's a little bit different because the IP is so long dated. So music is typically 70 years after the death of the artist. So if the artist is in his 30s or 40s and you buy the IP and they live for another 50 years, you have 120 years of IP and royalties. So you would expect it to accrete in value through time. But again, as you get to the end of the IP life, it would start to go to zero. So in all of our underwriting, we don't assume a residual value. We assume everything goes to zero. And therefore, you need to have generated your kind of low to mid-teens return target at the asset level on a cash yield basis. And actually, one thing I'd add is we don't underwrite exits in our strategy. We assume we don't sell an asset at any point over the next 5, 10, 15, 20 years. And we have to price all of our investments on the assumption that we only get the cash coming back from the royalty until it expires and goes to zero, which is very important. It doesn't mean we don't have exits. We do, and we have had exits. It's just we use it as an upside driver rather than a base case requirement.
And from a risk management perspective, I guess whilst you hold the royalty and you underwrite it with a terminal value of zero over a particular period of time, usually quite long, I imagine something like a healthcare product, or if you're backing a particular entertainer, and there could be an overnight issue which drives that towards zero much faster. How is that managed?
Yeah, so it's a good question, because really the crux of what you're getting at is what happens if there's an impact on the revenue line. Now, to be transparent, that is the risk that you wear as a royalty investor. 95% of the work we do is up until the day that we buy or lend or create the royalty. Thereafter, we are not operationally involved typically. It's a relatively passive investment. People think passive is a negative word. We actually see it as a positive sense. But you're right, if we have a royalty over Neffy as an example, and then in 3 years' time a better product comes into the market or a generic comes into market and takes market share, we wear that risk. And so all of the diligence is focused around what are the products in the market today, what are the products that are coming, what barriers to entry do we have, what moat do we have, and then being conservative on the underwrite. Same in music, because, and sorry, the other thing I should add is, on Neffy as an example, it's very hard to say, will it still be the best product in the market in 15 years' time? Because that is an awful long way away, right? It's hard to forecast that. And so we're very focused on trying to get our capital back as quickly as possible. So in healthcare investments, notwithstanding they're typically 12 to 15 years, we're trying to get our clients' capital back within the first 5 to 6 years, such that the last kind of 10 years are there to generate returns or outsized returns. Same in music. I mean, if you look at some of the artists we have in our portfolio, including the number one on Spotify globally. Again, I don't know what music I will be listening to when I drive home later. So how do I know what Joey will be listening to music-wise in 10, 15 years' time? And so again, it's all about structuring, get the capital back as quickly as possible, and to be very conservative on the actual underwriting as well.
And for the most popular, I suppose, in-demand royalty streams that might become available, I would have thought there'd be, you just mentioned the number one Spotify artist out there. That's something that in your portfolio. Would there be a ton of demand squeezing those return opportunity set? I mean, how do you get the rights and the royalties into your portfolio without overpaying to the extent that there's not actually much value or return out of it?
So look, it's a good question, and it's fair to say that the royalties market is competitive. yes, we're the only cross-sector royalties offering, but it doesn't mean that there aren't pension funds, private equity players, sovereign wealth funds, single sector funds in each of the sectors we invest in. There are. The real benefit of our strategy is that it's a relative value strategy. So yes, we have those three sectors, but we're not forced to invest into any of those sectors at any point in time. And so notwithstanding we had a target allocation to music of between 20 to 30% 3 years ago, we actually went nearly 2.5 years when we didn't buy a single music royalty for all of the reasons you just mentioned. There was a flood of capital that came into the music market. You may have read about it in some of the articles online. People were accused of overpaying, putting in a lot of leverage against the assets, basically underwriting an exit in 5 years' time. We couldn't get comfortable with that, and so we just stopped investing in music. And we're able to do that because we're not a closed-ended music fund. We have a broad spectrum of assets that we can go after. But to go back to your question, we typically try to stay out of auction processes. A lot of what we do is bilateral. We position ourselves as a long-term strategic partner to a lot of the IP owners in terms of buying from them or lending to them. We're really here to be an enabler to the great creators of IP. And I think that ability to invest out of an evergreen from a dedicated pool of royalty capital is also important, because a lot of royalty owners want to interact with somebody who they know is investing in royalties on a day-to-day basis. I'm not sure they necessarily want to be discussing with somebody who's in a credit fund who also does aircraft lease financing. And so the whole positioning of us as a standalone asset class in royalties with an evergreen pool of capital, it's a really good enabler in terms of getting access to the deal flow that we're looking to pursue.
And is there some, from a pricing perspective, some link to long-term interest rates? So if interest rates are lower, your return stream will be lower, and vice versa. If they go up, there's going to be an extra premium you receive off the royalty stream that sort of gives you an edge above interest rates over time.
Yeah, so I think there's two things. There's what does interest rates do to pricing of new deals that you're looking to go into? Now, let's assume you're in a scenario where interest rate, I don't know, the cost of debt is about 300 basis points, as an example, right? And let's say up until that point, people have been pricing a 12% return on a specific investment. If interest rates were to suddenly go up by another 300 basis points, in royalties, it doesn't mean that you can suddenly increase your pricing on a new deal from 12% to 15%. It doesn't work like that, because the argument would be you're getting exposure to 15 years of cash flow from a specific healthcare product, which is not driven by what is going on in the markets. Therefore, your returns shouldn't go up or down one for one with interest rates. Now, if there is a prolonged period of high interest rates, then maybe the 12% creeps up to 13.5%, but it's not going to go to 15%, because the seller will be looking at it as a uncorrelated revenue stream over a 10, 15, 20-year period, and therefore is not really driven by near-term shocks in interest rates. Now, once we've made the investment, I do think it's important to note that we don't fund the costs, so we don't suffer from cost inflation. It doesn't eat into our returns or our margin. Now, if there is cost inflation, in all likelihood, it means that the price of the product is also going to go up in order for the operator to maintain their margin. And given we're exposed to a percentage of revenue, in periods of interest rates going up, which is typically because of inflation, we would expect the price of the product being sold to go up, and therefore our returns actually move positively with inflation. Again, we don't underwrite inflation into our underwriting, so if there is inflation for us, it's a cherry on top above and beyond the underwritten return that we targeted.
And then following on from that, final question from me. In the context of, you've been obviously doing royalties for a long time, I presume talking to outside the founders themselves, institutional investors, high net worth investors globally, most of them tend to have big exposures to equity markets and to debt investments. Where does royalties fit into a sort of typical portfolio that might have large exposures to both those asset classes?
Yeah, so I would say two things. One, the correlation we've seen over the last 7 years of running this out of an evergreen with external capital in that evergreen for 7 years now, we've seen very limited correlation to any other asset class, for the very simple reason that even within our own portfolio, we have very limited correlation, because how much you listen to a certain artist on Spotify is not linked to how much you will watch of a Warner film or TV show. It's not linked to how much of Neffy you'll buy for severe allergic reactions. is not linked to how much gas somebody needs to buy in the US to power a data center. So our investments themselves are not typically correlated to each other, which is what we love, because we're basically taking and cherry picking revenue line exposure to best in class assets in sectors which we think are pretty resilient and countercyclical. So then when you put them together, you end up with a strategy which over the last 7 years has had a volatility of less than 5%, and it just doesn't move in line with other asset classes. So we're not here to replace any asset classes that your clients will have in their portfolio. We're here to do what we did for the founders, which is just to be something different, something which is focused on yield, not reliant on exits, in resilient counter-cyclical sectors, and is uncorrelated. Now, over the last 7 years of doing this with the founders and 13 years of doing royalties in totality, we've seen clients put it in different areas of their portfolio. The founders had it in their real assets bucket. Sorry, they continue to have it in their real assets bucket. We've seen people put it in their alternatives. We've seen people put it in their income bucket, their yield bucket. A lot of people put us in their diversifying credit bucket, because while we're not credit, we do have some characteristics which are more similar to credit investing. And actually, if you think about a credit portfolio, in periods where interest rates are low, royalties will help continue to generate the yield that investors like. And then when interest rates go up, having royalties alongside credit can really turbocharge the yield. So we've seen it play a role in a lot of people's portfolios. We've recently had a sovereign wealth fund create royalties as an asset class in order to allocate to our strategy. Now, one day we'd love all investors to have a royalties allocation specific, but as of today, we've seen people put it in different parts of the portfolio.
Stephen, it's been absolutely fascinating to hear about an asset class that many investors would be less familiar with. Thank you for taking the time to speak with us today.
Thank you for having me, Joe.